Well, let's say thanks for everybody being here today. So again, I love these kind of Saturday workshop events so we can all kind of kick back. Markets are closed, which makes it a lot less distracting. So we can just kind of really talk the markets. And we're going to focus on today is, what I call the option strategy guide, and it's when and how to use which option strategy for the best results. So, you know, picking the right strategy often is a hard thing to do because there's so many different market, variables and things like that. So I'm going to go through some steps here that I use, and hopefully it'll kind of make it a little bit easier, more, give you more clarity on what option strategies that you might want to use in your trading. So, a little background on myself. I started my trading journey back in the 80s, and I was fortunate enough to get in with kind of a training program where they had at a company called Coastal Corporation, where they actually, take you in and teach you how to trade crude oil and oil products. So it was a really cool program. And I was able to get my foot in the door and, had the opportunity to, get in the program. So kind of started out with a really cool thing. You go down, they had a bunch of different oil refineries. So they had one down in Corpus, Texas, Cruci, Texas. So I went down there for about 3 months and just kind of, basically learned kind of, how the, crude oil would come in, they process it, take it through the distillation towers, all the things, just so you could really understand the fundamentals. So it's really great for anything you're doing, obviously, to understand the fundamentals, and it just makes it more clear to you, as how to do it in the future. So that was great. Ended up, then going into their shipping department and learned how to charter tankers and all the operations. So finally got into the cargo side of things, trading crude oil. Sent me out to Singapore for a couple of years, traded, oil products out there and Asian crude. So that was a fantastic experience. Ever get to go to Singapore, make sure you do. It's a beautiful city, country, whatever you want to call it. It's a small place, but pretty amazing. The food is fabulous there too. And then I got a really great opportunity back in the mid 80s. I went to work for a company called Trans World Oil, which at the time was the largest oil trading company in the world. It was Trans World, Fibro, Mark Rich. We were the three big companies, and so it was just a fantastic experience. So I ended up spending about 17 years with Trans World. About 15, 16 years of that was in Bermuda, which was their corporate quarters, which was just a beautiful place. And then ran the international trading desk for 10. So that's where I started trading options back in 1987. I'll never forget. They would have the Wall Street guys would come in, Goldman Sachs, J. and all these Drexel, all the people. And they would, basically, options, they were introducing options at that time to the markets, and nobody really, was trading options in oil. So it was really fascinating. So they come down and kind of teach you the basics of options. And then we got our, Black-Scholes model set up, and we, went to work trading options. So the first thing we did was selling, premium on cargoes of Brent crude oil. And it was really fantastic, and it worked great until it didn't work. So that's the thing that we're going to talk about here today. So that's kind of where I got my start, and never looked back. So I've always been passionate about the option side of things, and we'll talk about that in more detail here today. So the following presentation is purely for educational purposes. Any stocks, futures, or options mentioned does not constitute advice and should not be construed as a recommendation. So the secret to trading profits, one of the big components is options. So, when we're trading and looking at trading is really a business of probabilities. And to be successful as a trader or investor, controlling your risk is really what's going to win the game and keep you in the game in the long run. So by knowing and better understanding then how to manage and control your risk, it's going to make a dramatic and positive difference in your trading or your investing performance. And one of the best ways to achieve this is through the use of options. So you can use options from day trading, swing trading, long-term investing. So there's really no better way to trade or invest for unmatched greater returns with much less risk than through the use of options. Now, when we're trading options, they have so many more advantages than just trading outright stocks or futures or something like that. But you can be, it can be really confusing and kind of debilitating to traders and investors unless you know which option strategy to use and when, and then how to use it correctly. So based on, the market environment and everything else that's going on, So I call this debilitating trading dysfunction. I call it the option strategy confusion. So OSC. So it's, often out there, and it gets very confusing, especially when the markets are, racing up or down, or there's uncertainty. Sometimes you're scratching your head, okay, what option strategy should I use? So when we look at this strategy guide we're going to go through, it's going to kind of highlight what you'll need to know to successfully trade options. So no more OSC, option strategy confusion. Now, step one is to understand the basic fundamentals of option, and that starts with option pricing and how it works. So this is really going to help you to, once you understand this, you can, then be more clear as to, what strategies to use and how you can then, maximize your profit. So the first thing is pricing the option. When trading options, the most important option factor comes down to understanding the concept of time and volatility and the impact these two things have on the price of your option. So the first component, which I call the time price component, is what we also refer to as extrinsic value. So that's the time value of your option. So, the option premium is what, a rational investor or trader is going to be willing to pay over that current exercise value, the intrinsic value, based on the potential of that option to increase in value before expiring. Now, the change in this value of your option based on time decay, we can actually measure that with the Greek call, what we call theta. And so time decay then always works against buyers, and it's going to benefit the sellers. So why is this? Well, we can look at theta, we can see what the theoretical values will be up or down in your option. So when we look at theta, they're going to have either a positive or a negative a value or characteristic. So, all long stocks or long stock options, such as if you're long a call or long a put, they're going to have a negative theta value. So that's going to indicate that they're going to actually lose value as expiration draws near. So if you've been out there and you bought options and your price goes nowhere, you're going to understand and experience that loss of time value, and your option goes down and value depletes. Now, the opposite side of that is if you're short the option. So if you're short that call, short that put, that position then has a positive theta value. So that position is actually going to gain value as expiration draws near. So even if the price does not go in the direction you need, it goes sideways or whatever, stalls out, you're gaining that value. That premium you collected is going in your pocket, and it's staying there as long as it doesn't go to the short strike. Now, many option trading strategy then will also sell out of the money options on top of buying the at the money or in the money options in order to offset this negative theta value. So what this does is going to result in lowering that rate of time decay, and also it's going to lower your capital at risk. So that's why I love option spreads. So I'm obsessed with time decay, which we'll talk a lot about here today. But also the other thing, I like to keep my trades very, very low risk, low capital at risk. So by doing different spreads, we can, number one, we can reduce that theta decay, but we can also really lower that capital at risk. And then that's going to give us some really fantastic leverage returns on low risk. So when you think of leverage, a lot of times you're thinking, wow, you're taking a lot of risk. But actually options are less risk than if you're doing anything else, any other kind of trading out there. So when we look at things like such a vertical bull call debit spread or a vertical bear call put spread, these are going to be strategies where we can offset some of that theta decay and also reduce our capital at risk. And then we have the butterfly spread, which is another great way, and a long condor spread. So these are, really great spread strategies for reducing theta and reducing our capital at risk, which is going to increase our return on capital of every trade that we're looking at. Now, the next big pricing component is the price volatility. Now, implied volatility, though, is what is expressed as a percentage, a theoretical percentage of the stock's price, indicating a 1 standard deviation move over the duration of its option cycle or series. So in theory, a stock should end up, within about a 1 standard deviation price range of its original price of the time during its option cycle. Now, this theoretical probability or forecast of the security's price range should be part of the process that you're using for selecting the highest probability price targets for your trade that you're going to take. So this is a really important thing to understand, volatility, and then how to understand the standard deviation for setting your price targets and have an idea of what's a realistic target for price to go to. So then we look to put together a price of an option, and that comes down to that time value component times the implied volatility times the intrinsic value or the underlying security price. So once you know these variables, then you're going to be ready to price out the option, know what that option premium is, and then select the appropriate option strategy for the environment you're trading. So here's just a good kind of table diagram to kind of illustrate how these price components flow. So this is basically like on a weekly option. So every Thursday, we'll have a new weekly option series come out. So, currently almost all of the big stocks are going to have weekly options. And then we have the ETFs, which have weekly and daily options, which are even more awesome. So when we look here on a Thursday, we have that full first day, we have full 100% time in that option when we start out, right? And then we take the implied volatility. So time value times the implied volatility times the security, the underlying value of that. Now we're going to keep this intrinsic value constant at 1 to show you then just how time and implied volatility affect the option price or the premium of your option. So that day 1, we have 100% time. It just starts out brand new. We have 100% time in it. And I've plugged in a number here of 300 for the implied volatility. So you can see 1 times 300, we leave this constant. So you can see your price of that option would be $300. Now, when we come back in after the weekend, even on the weekends, we're having that time decay. And so let's say we come back in this Monday, and that option now is cut in half. That time value component is, now only half of what it was when it started. It's decaying, right? And so even if we jack up the implied volatility, I plugged in 800, kept that constant, you can see the value of the options 400, so it barely went up. So let's say the implied volatility though was low, and let's say it was only 200, and your time component now is 50, so you can see your option value would be $100. So the real takeaway, hopefully you'll see, is that time value is going to go to 0 at that option expiration, and implied volatility goes to 0 too. So we want to understand as option buyers or seller how this is going to impact the trade that we're putting on, and then all the different other strategies we can do to take advantage of these two pricing components. So hopefully that bears a little light on how that option prices work. Now the next thing is step 2 is trading time. So this is the really big component. So when we're looking at trading options, we can actually trade time by selling time to take advantage of that option time decay or theta. Now, when we're selling an option, we are in essence selling that time, and then we're also selling volatility. So again, another great kind of analogy of an option is think of it as like a coupon that you're going to get at a store. So you get that coupon, you see, okay, I have to use this by next week or the end of the week. So I have to kind of redeem it by that expiration date, or else it's no longer valid. Well, that's exactly how an option is with all the different option series. At the end of that series, they're no longer valid. They go to 0. So it's like a coupon. So when we look at the time component, we forecast and we go out in time, you can see this illustrates how slow time decay starts off. So we're like 120, 90 days out, or the further out we are, there's very little time decay. But once we get to around 30 days out, then it really starts to escalate and really starts to tail off. And then we have those weeklies, and those really accelerate. So that's the great thing we can do. We can use these weekly options to construct different option spreads to take advantage of that accelerated time decay, or the cheap options because of the less time decay involved. So you can see how that graph kind of slowly kind of drifts off, and then it really escalates. And at the end of the day, at day 0, they're worthless, right? So that's how that time decay goes. And so one of the big things when you're buying options, a lot of times you might hear the gift of time is the gift of a buyer of an option, because it starts out real slow. So that's kind of to illustrate that time decay component. Okay, so the step 3 then is the trading the probability. So this is what I kind of refer to as the market maker's secret. It's what they really don't want you to know, because once you know all these different things about how options pricing works, then they're not going to be able to take advantage of you as much, right? So when we look at the option market, the markets use mathematical market probability statistics for pricing the movement of your option to its expiration. Now, most of the option models are based on what we call the Black-Scholes models. They have some little different tweaks to it, but that's the common kind of foundation of these option platforms that you're currently using. So the Black-Scholes models, which plugs in price, time, volatility, those kind of things. Now, by knowing the probability of your underlying security finishing within a certain price range at expiration becomes key then to determining then what options you want to buy or sell, and then what option strategy to use. Now, we can use kind of a theoretical forecast, and we refer to this forecast, this option forecast, as the implied move of the stock or the implied expected move. And so this implied expected move is basically a theoretical estimation of a plus or minus 1 standard deviation move on the underlying security, by its expiration. So this is the place where we start with every option trade. Before we ever do anything, we want to know what is the expected move so we can see that theoretical normal price potential movement. So let's say we were selling an out of the money option, 1 standard deviation out. You're going to start out that trade with an 84% theoretical chance of winning. Now, one more thing I'd like to kind of mention, when I look at standard deviation, I will call that out as kind of a normal price range, okay? So let's say you have 1 standard deviation, you're currently looking at, and the price is trading here at $100 or something like that. And so the 1 standard deviation range up might be, let's say $150, and then, down it might be, to 90. So that is kind of the normal, range that price could go up or down. Now, when you exceed that 1 standard deviation, then it starts to get extreme, lower probability that price will get there. So the way we can use probability to quickly assess it is what we call the delta, the option delta. So when you look at the delta of option, so it's got to be either a plus or minus 1 when you look at your option platform. So if you've got a 1 delta, that's equivalent when you're buying an option or selling options. 1 option contract is equivalent to 100 shares. So that kind of rounds up what an option delta is. So the option delta represents 100 shares of the underlying security, okay? So if you had an option delta, like here, it says the expected move for this example here would be plus or minus 4% up or down. So that would put the expected outside price point here in this on this price curve, this bell curve at 520, and on the downside, it's going to put it at 480. So that'd be like the expected move of plus or minus 4%. All right. So if we were to sell this outside price point here, the 520, that's going to have a delta of around 16, or it's, basically what it's saying is that it's got a 15.9% chance of exceeding that 520. So that expectation of, exceeding it goes down lower and lower. So the further you get on the curve, like here's 2 standard deviations, so very low probability to get there theoretically. So if we look at this price point here, that's roughly like a 16 delta. So this would be like a plus 16 delta. And on the opposite side, the 480 would be the other, price point of that 1 standard deviation down. That would be like a minus 16 delta. So if we take that 16 delta less the 100, that's going to give us the reciprocal of that is 84. So one way we can look at that is that if you sold that 520 strike, there's an 84% probability theoretically that price will be below 520 at expiration. Or if you did the other way around, let's say you sold a put, the 480, there's an 84% probability price will be below. Now, as we go further and further out, like here, 2 standard deviations, that's basically like a plus 3 to 5 delta. So you can see then your probabilities are getting either less and less. So typically, if you were to sell, say, 2 standard deviations, there's a 5% probability, only a 5% probability that price could ever get there. So the probability that price would be below is 95. So that's how we can quickly assess probabilities of your trade. If it's going to be a good one, if it's going to be a kind of a trade that's makes sense and not too extreme. So a lot of times, when you're starting out with options, you see these cheap options, you think, well, let's go buy a bunch of those. But they're cheap because they're very, very high risk, very, very low probability that trade will get there, and that's how we can assess it with delta. So here's just another good example of option delta. So this was, an example on Apple. Apple trading 190, 28 days to expiration. It's like a 5 July series. So if we look here, it's traded at 190. So the at the money strike right here, 190 has a delta of 50, 52 basically. So that's 50-50. So there's 50% probability that price will be at 190 or below, 50% probability that it'll be at 190 or above. So that's how your probabilities, you can measure those real quick. Now, let's say we go way out here to the 215 strike, you can see over here under delta, and this is probability out of the money, you can see the delta here shows a 5, right? So you can look at this a couple different ways. The way I would look at that is that if you, let's say you bought that 215 strike and you can see it's going for like, $26 or $30. So these are cheap options. And the reason is you've only got a theoretical probability of 5% chance that price could get to 215 over this next 28 days. Or the other side of it is probability out of the money is 95.61, or there's a 95% probability that price will be below. So there again, here's your 100 delta, less that delta of 5. So probability out of the money, 95. Okay, so that's the way you can read and back into what that's telling you, that information. So really good information right there, quickly you can assess. Now then, by using this probability analysis, this is going to really give you a very useful tool that you could quickly use to determine price targets to trade against. And it's very, very useful then for also setting hedges. When something goes wrong, you can look at the probabilities of where maybe you should set that hedge. So based on the math of probability, you can really see that approximately 70% of options bought are going to expire worthless. And based on this, it's a really good idea for traders, investors to also consider the selling option side of things as well as buying. Now, what I love to do is combining the two together. So when we're combining the two together, buying and selling options, we can then create really unmatched option trading strategies that are spreads that are going to then help us provide us with greater returns, lower capital at risk, and lower theta on our theta decay on our option trade. And so this really comes down to kind of a win-win for all your trading or investors out there. So it's really important to understand these concepts of time and volatility, how they work. Now then step 4 is, comes down to selecting the perfect option strategy. So let's take a look at some of the ones that I really like to follow in the process. So the process is, first you want to say, okay, what's going on? We always want to identify what is the market cycle. So there are not a lot of different ways we can do this, but power cycle trading, we use our trading indicators that I've developed to give us the cycles of the market. So do you think the market's going to go up, down, sideways, or have no idea? So what is the process? First, identify that cycle. Okay, so the next step is once the cycle, we're currently in an uptrend, right? Kind of starting to get a little bit sideways, but we're still in a major uptrend. And then the next step is to identify the chart pattern. So I really like to follow chart patterns. So I've kind of identified and put together 5 really high winning probability type chart patterns that I look for trade setups. Then the third step is, what is your time horizon, the trade duration? So when do you expect that trade to make money? Do you think this is going to be a trade that can make money tomorrow, or is it going to be a trade that you need to hold on a longer term basis, maybe a week, 2 weeks, maybe even months? So what is your trade duration? So you need to understand that. And then 4 is, what is your capital at risk? So based on the market condition, you're going to look and assess and quantify your market condition. Are you in a low risk environment, medium risk, or really high risk? Okay, so right now, we're in kind of a lower risk environment. Things are just been, grinding up. The news has kind of been, pretty decent all the way. So we're not in a lot of high risk environment. So we can then do different strategies. Now, when we're in extreme or high risk, we're going to want to limit our exposure. So we're going to reduce trading risk, and there are option spreads that we can do to really, help us do that. And then 5, what is your objective? Are you looking just for passive income, just kind of, monthly income to bring in, or are you looking for income and just, big, good profits, that you could kind of capital gain type profits? Are you looking for, do you need some more hedging, or, you're looking for those capital gains? So what is the objective of your trading, or maybe it's your investing. So you need to kind of go through and identify that for yourself, this kind of process to use. So kind of go through and then, you know, start thinking about this. All right, so the next thing then comes down to the option strategies and when do you use the various strategies based on the environment you're trading. So we're going to talk about long calls or puts. We're going to talk about the vertical debit spread. There's the vertical credit spread, butterfly, long condor, calendar diagonal. So these are a few. There are just multiple other strategies, but these are kind of the main core strategies that I like to follow. Before I get too far though, I'm going to go put this out there real quick in case anybody has to take off early for summer vacation parties or whatever. So next weekend, I'm going to start a course just on, you know, on this in greater detail. So it's the Ultimate Option Guide, when and how to use switch option strategy for the best results. So let me give you the link here, and this will, you know, give you this opportunity to take advantage of this course that's coming up. So click on that link that I just put in, powercycletrading.com/special. So when you click on that or copy it and paste it, you're going to get a drop down window, and this is going to give you the chance to sign up for this course, register, and also you're going to get a 15% discount, you know, if you use this today. So if you go here, put that powercycletrading.com/special right there. You can see the link there. So put that in, and then you're going to get 15% off if you use the OP15. So small cap, which, you know, OP for option 15, that's going to give you 15% off the course price and the package prices that I'll show you. So let's go through this real quick, and then we'll, you know, go into more detail on everything I was talking about. So here's what you're going to get. And if we go down here, you can see there are two packages that you're going to have a choice of. First package is course package 1, would just be for the course next weekend. So this will be about a 5+ hour course. That's what I call my Option Guide Masters course. And so this will start out next Saturday, and then we'll finish off, you know, Monday after that. But with the course price is $197. But if you use that OP15, you're going to get 15% off. So your course price today would be $167. Now, I'm also, you know, going to include with this price of $167 today, all these additional bonuses, because these are going to help you, you know, be more successful in your trading in general. So you're going to also get my Option Masters course that was done prior, which you can see it's on the website for $597. Now, this is more theoretical, goes in all the different Greeks. Okay, so I want you to have that. So we're going to do the live course, which will be, you know, live and recorded, but this one is also going to be really focusing more on the Greeks. So I want you to have that. And then I'm going to give you my price target mapping course. This is how we map out price targets up or down for defense or profit targets. And then another option course that I want you to have is Get Started Trading Options. So these are all prices on my website. And then you're going to get a 30-day trial membership to my trading club. So $97 a month. If you continue on, which hopefully you will, it'll be $97 a month. Or we have other, you know, programs you can get into. And then these are two really important indicators that I use for all my trades. So I want you to have these as bonuses for the course. So you're going to get my cycle reversal indicator, $197 on the website, my extreme range band indicator, and then we're going to do a follow-up Q&A. This will be probably Tuesday after that Monday finishing of the course. You're going to get my option trading tutorial, another option course, you know, with videos, and then my 15 option strategy guide. So, you know, some really great bonuses. Total of that is over $2,000. So the course though is $197, but today with that discount, you'll get it for $167, and you'll get all these bonuses included. So that's course package 1, and if you just go here, click buy now, and then put in that OP15 small cap, put that in, apply, and boom, you'll get that discount there. And then if you want my indicators, you can also get those with kind of an upsell that they're $195. So that's course package 1. And then if you want my alert service to combine with this course package, that's course package 2. So this is where you're going to get, if you want this, you're going to get all 5 of my trade alert service, alerts that go out for the next 4 months, and then plus 4 months to my trading club. Now, with the alert service and with the trading club in either package, you can start when you want, and you can start this service, start and stop when you want. So if you go on vacation or whatever, you're not going to lose time. So this package will get, all my alerts. So you can see here, we'll go through this in more detail a little bit later, but since through yesterday, since I started the inception of the services back in 18, we've had 743 trades closed out, 538 winners, 47 break even, 158 losers, right around a 79% reliability or winning rate. Now these are unaudited, but this is kind of a summary of it. So this is going to be $597 with the 2-pay, but if you use the 15% off, it'll drop this down to I believe it's 507. All right, so use the same code, that option OP15. So you get access to all 5 alert services that I send out for 4 months. We do 10 to 12 stocks or ETFs primarily. So the different types of alerts that you might get or have sent out would be selective breakout reversal, credit spreads, things like that. Do a lot of counter diagonal trades. These are sent out alerts. We're doing monthly penning trades, butterflies or calendar penning trades. And then we do a lot of butterfly and long condor trades and selective earnings trades, which are usually a lot of times double calendars. So these are the potential trades that, when I send out a trade, it'll be the price point where to get in, and then, the option strategy to use if you want. And so I'll give you the trading guide for each, what option strategy, do a setup video review each day after the close. These are all listed and archived. And then you're going to get, for the next 4 months, we do a weekly Q&A every week, live and recorded, daily video newsletter every day after the market closes. And the big plus is my virtual trading room. So you have access to that each and every day over the next 4 months. And then anything on my website, courses or indicators, you'll get everything 60% discount. So those are the 2 links there. And then if you come down here, you just, again, go into here and click buy now, and then put in, there's also 2-pay if you want, and then put in OP15. And that'll give you this discount of 15% off. So it drops you down to 507. And you can also do a 2-pay. And also, if you want the indicators, you can get those. So just kind of wanted to put that out there real quick, and then we'll move on. We'll talk about this more in detail towards the end here. And you also ask questions if you have anything that you need to have clarified. All right, so, when we look at kind of backing up, we're going to look at different things. Today, we're going to talk about calls and puts, debit spreads, credit spreads, butterflies, condors, calendars, but these are kind of the basic ones where I start out and what I kind of typically go to. These are my go-to strategies I like to use. So when we look at long calls or puts, these can be used for day trades, swing trades. Those are, trades which I kind of define that could last 1 day to maybe 10 days or a little bit, maybe 2 weeks. And then you can also use them for longer term, trend trades that could, go on for weeks or even potentially go further out, months out. Now, generally, when I look to use debit spread or, just go long calls or puts, I typically look at, going long at the money, like a 50 delta, or maybe a little bit in the money, like up to a 70 delta. So these are defined risks, but they're, going to offer you unlimited profit potential. And then we have the next kind of combination here, which we call the vertical debit spread. So the debit spreads can be used for your swing trades as well, or long-term trend trades. And these are also defined risks. Now, these are going to lower your capital at risk because it's a spread, and it's going to also lower your time decay, because you're going to offset that negative theta with positive theta from the short side of the trade. So your profit upside is capped, but your downside's capped, and this is also going to increase your potential return on that lower capital. And then we have what we call the vertical credit spread. So this can be used for day trades, swing trades. Now, best used when your implied volatility is higher. So as implied volatility goes up, premium of your options go up, and so you get more premium. Now, these are, when we do it as a spread, a credit spread, they're also defined risk, takes advantage of time decay, sideways price action for its profit. and the profit is capped based on just the premium you bring in as your potential profit. So let's take a look at the kind of the profile of just a vertical debit spread. So here's an example of like a vertical debit spread that's like a $10 wide or $1,000. So you can see here, this would be like going long a call, and you can see the price down here is 10.10. All right, and then let's say we sold a call against it at 10.20. So you can see that's a $10 wide spread. Now with one option contract, 10 times 100, so the spread width then is $1,000 wide. All right, $10 right there times $100,000. Now the debit spread, so your long call, short a call, that's not going to reduce. Your long call is going to have a negative theta value. The short call a positive, plus it's going to reduce your risk. So in this example, we could show and lower our risk down to $300. That's the debit paid. All right, so then your potential profit is the difference between the spread width, the debit cost there. So potentially you can make $700 if at expiration it closes above that 10.20 or higher. Now your profit then is capped, but your max profit would be 700. On your risk at 300, that's a 233% return. Or the other way to look at it, that's a positive risk reward ratio. So you're risking $1 to make $2.33. So really a decent positive risk ratio, a little bit over 2 to 1. So love these kind of debit spreads, and we're going to reduce our capital exposure and reduce our theta, and reduce our risk. Now the other one is what we call the vertical call credit spread. So in this example, you're selling premium. So you're selling, premium to take advantage of the potential for the market to pull back. And these are what we also refer to as those probability trades. So, earlier I showed you if you sold that, 16 delta or further out, the probability of your trade closing below that short strike could be, 80, 84%. So these are going to be, lower, amounts of dollar bringing in, but starts you out with a theoretical higher probability. So in this example, let's say you sold that 10.20 strike short. So instead of being naked, and then your exposure, if you're naked short a call, if the market goes up, you have unlimited potential loss. So what we're going to do with these, we do it as a spread. So we're going to cap our potential risk in case the market rips up. So you're short here the 10.20 call, and you're long above it the 10.30. So again, $10 wide, so $1,000 wide spread width. Now with this, the premium that you bring in is $200. So you're receiving a credit of $200 that goes straight in your bank account. And then with the broker, you have to put up the margin, the difference. So that would be $800. All right, so you bring in $200 credit. Now your potential though loss, you're capped, but your potential loss could be $800 if it market goes the other way, up over to 1030. So if you look at this has a negative risk to reward ratio. So you're actually risking $4 in order to make $1, okay? So that's the difference. So these are, again, probability trades, but that's why the premium, the return on your capital at risk is going to be lower and negative, because you're starting to trade out of the money. So theoretically, you've got a greater probability of that trade working out. So that's a credit spread, okay? Now, when you combine the two together, that's where it really gets interesting. So we can then, mix and match and create all these different cool spreads. So one that we can create is what we call the butterfly spread. So this is a really unique option strategy that combines both buying options and selling options together. So it combines the vertical debit spread and then combines that with the vertical credit spread. So we can take advantage of the vertical debit spread, which is going to reduce our risk, but also it's going to have a negative theta. So we can then offset that negative theta, reduce our risk even more by adding a vertical credit spread to it. All right, so that's going to give us a very defined risk trade. It's going to really help us to take advantage of time decay and the implied volatility. And so we've got the sell side where we're selling the vertical credit spread, so we're selling more time and volatility on that. It's going to always give us a positive theta, so no time decay. So I love that. Great for directional and non-directional swing trades. Trades could be on for a day to 2 weeks. That's kind of the sweet spot. And then when used correctly, it's going to give us really high returns on our capital at risk of the option strategy. So of all the different option spreads, the butterfly will give you the highest return on your capital at risk of any option spread out there. So I'll show you one that we had, which was, you know, about a 2,400% return, which is, you know, you think that's impossible, but I'll show you that how these things work to get those potential kind of returns. And then great for hedging. When you really want to reduce your exposure to the market, fantastic way to drop that risk way down. So here's just your kind of a simple profile of your call butterfly. So if you look back to that call debit spread, we had that long call here at 10.10, and we had the short call right here at 10.20. Now, then we had a credit spread. If we sold another call at that 10.20, bought a call here at 10.30, that creates a butterfly, all right? So this then would knock down that risk in that example to $100. So the first trade, we had a $300 debit, right, on the call debit spread. Then we had the credit spread here, brought in $200. So now we've dropped our risk to just $100. And we've got this big profit zone. So the top of the 10 is where you'd have your max profit. So theoretically, this could make this $1,000 wide spread. If you went out right there at expiration, your risk is dropped down to 100. So potentially you can make $900 on your risk of 100. That's a 900% return. So that's how these things can work. But if it goes out in here, you still make a great return. So then the next one, the variation off that, I kind of call this the cousin to the butterfly, is the long condor. So like the butterfly, it combines, you know, buying and selling. So it combines that vertical debit spread and the vertical credit spread, but it does not share the same short strike of your debit spread. So it widens it out. So it moves that vertical spread, credit spread short strike further out of the money. This is going to give you a bigger profit zone. It's also going to give you positive theta, no time decay. Great for directional swing trades, 1 day to 2 weeks. Provides a higher return. Great, you know, capital on risk is lowered. Also great for hedging. So here's kind of what it looks like. It's a variation of the butterfly, but we're going to widen out that profit zone there. So I like this, you know, to give yourself a wider profit zone so you don't have to be exactly right to thread that needle at expiration. So we do a lot of long call condors. So we can do this with puts or calls depending on the market direction we're trading. Now the next one is what we call the calendar diagonal. So this is another really favorite. So this is a really medium term to it can be a very long-term kind of directional option strategy to use. So it's great for speculating on trend and for hedging. And this, you can go out with these. I mean, you can go out years, you know, so you can make this into a really long-term trade type situation for longer term investments if you want. So what it basically is, it's a vertical, called a vertical diagonal debit spread. So it's where you're going to have the long option leg. It's going to be set further out in time. So your expiration is going to be further out in time versus the short option leg, which is going to be closer into time. So when you're looking at, you know, the spread, you're going to be, you know, long your leg further out, so it can be calls or puts depending on the direction we want. But then we're going to be short closer in to take advantage of that accelerated theta decay. All right, so it's going to also then, as we sell options closer in, we get a more, you know, we get a bigger premium a lot of times because our accelerates more as it gets closer to option to option expiration. So what it does, it takes advantage of that short-term weakness or strength that you might think will eventually in time revert and cycle either back up if call-based or back down if put-based. So this provides you time to let that directional trade kick in. So love to use this strategy when we have a kind of a market that's been, you know, really going down real hard and finally starts to bottom out, but we're not sure exactly when it might turn up. So we can use this strategy to kind of work the trade. As long as it holds our support, we just keep, it's like a covered call. We just keep, you know, we're long the longer dated option, and then we just keep selling options against it until it finally breaks to the upside. So I'll go through a couple examples of how this works, but it's a really favorite trade strategy. And again, we can use, you know, if we're looking for a move to the upside, we've had a hard down and we're moving up, We'll do this using calls. If we had a situation where we had a big uptrend, it finally moves down, we can do it with puts. So the other plus, though, it gives us a positive implied volatility difference between the two option series. If the front month or front series has higher implied volatility, this is going to also give us a positive skew. So we'll talk about that a little bit more. But these are kind of an outline summary of what they do. Now, the big plus, though, is the additional vertical spread component. So what this does is adds a directional element for greater profitability to the trade. And this is what I call, buying options at a discount. So the trade is set up as a net debit, and then, we can, stay with the trade. If we think it might take a little bit longer for it to turn up, we can just kind of keep working the trade like a covered call. But instead of being long the shares, we're long the further, long dated options, which are going to be much cheaper than being long the shares. Okay, so that's the basic concept of it. And we do a lot of these. So here's kind of what it looks like, so you can kind of wrap your head around it. So let's say you're just a vertical debit spread, and so next week is the 28 June series, right? So next Friday, I believe, is 28 June. So if you just did a vertical debit spread, you're going to do it in the same series, right? So it might be your long a call here, short a call, and this is the 28 June series. All right, so everything's in that same series. Now, this will, give you, it's going to reduce your capital at risk, but you're going to still have a small negative theta. All right, so if you do this. But if we move the long part of the trade further out, it's going to have, less theta decay the further we go out, and then we're going to have the short dated closer in. So, for example, we would, instead of being long the 28 June call, short the 28 June call, what we're going to be long, we'll still be short the 28 June call, right? So it's going to have really more accelerated theta, but we're going to go out and be long further out the long call, so we could go out as far as we want. So let's say we might go out to the 5 July or something like that. So we might be long out the 5 July call, which is going to have less of a theta decay further out in time. Remember, we have less theta, but we're going to be short closer in, which is going to have more accelerated. So this is going to give us a positive theta trade. And then we don't have to be exactly right on when the trade turns up. So we could even go out here to like the, 15 September or something like that. So we can really structure these things for long-term, really great structure. So these are trades that we do a lot of these, which I'll go through a bunch of examples to show you, but this is one you definitely need, for your trading portfolio, either trading or investing. So let's go through some examples now to show you kind of how these things all work. So we've got the ones I'll talk about, and these are kind of my favorite go-tos that we'll do, is the vertical debit spread, the butterfly spread, long condor, and then that counter diagonal. All right, so then we can structure these for moves up or down, either using calls or puts. So first one is just a long debit spread. So this is going to be a long debit spread, but this is going to be one that's based for a short. So these trades examples I'm going to show you are ones that we've done. These are alert trades that were sent out to the alert trade members. So in this one, this was actually going short IWM, the Russell, okay? But we did it with a long put debit spread, all right? So we kept our risk super low by doing it as a debit spread. So why would we do that? Well, we can define that risk. We can really, really tailor that risk to how big or low we want it. Great for directional swing trades. It's going to lower that capital at risk, reduces our theta on the long option. So, if we're just long puts, we're going to have, really big theta decay. But by offsetting some of that with the short call, short put against it, that reduces that theta decay. Great for trading high volatility markets, so we reduce that risk. So we're not just long a put, we're short a put against it, reduces the risk. Trade duration can be 1 to 3 weeks out or further if you want. Returns 2 to 1 to 4 to 1 are kind of the normal kind of returns you can look to have or expect. So here's one that we did not too long back, and this was a short trade that we set up on the Russell 2000. So we did this set this up on the 7th of June. This was like a Friday going into the weekend. The markets looked like they were going to, take a dip down. So we wanted to keep the risk super low. So the trade says new IWM short. At that time, when we set the trade up, when I sent the trade out, it was traded at 201.36. We were looking for what I call cycle high reversal pattern, daily negative momentum on our momentum indicator. So it looked like things were setting up for a move lower, but we wanted to keep the risk low. So here's the risk, 48 bucks, 48 cents was the risk on the debit spread, or $48 per spread. And then here it was Monday, right on the open. I sent out before the open, right here, I sent out this alert saying, okay, short the IWM. It's going to be trading around 199.54. That was our target, 199 right there. So in the pre-market. So if long the 10 June 201 199 put debit spread going to target 199, try to work your profit on the open. Fast moving market. Anyway, so that's what was sent out. And so debit spread 48 bucks risk or thereabout. So here's where the trade started out. You just kind of see these trades are all based on kind of market direction using my indicators and cycle model. So here was the trade setup. It was going short right here. It was trading at 201.36 right about here. And it was breaking down. And then this was on a Friday. So the next day on Monday after the weekend, it came in here right on the open. We closed out the trade right there. So that was our target 199 and it was trading right there. So we got a really quick return on low risk to the downside. So here's the profile, what it looks like. So this was a put debit spread along the 201, short the 199. Total risk was the debit paid of $49. So potential return at expiration on that day would be $151. But we got out right on the open because a lot of times markets go down and then they slingshot straight back up. So that's kind of what we were thinking would happen, and that is what happened that day. So took profit right on the open on this trade. So we had a risk of 49 on the trade. Closed it out right there. It was trading on the open right there at 199.40. So right here, now the max profit, if it had closed below that or at that or below on the end of that day, would have been much higher. But we went ahead and closed it out. Still $80 profit on the risk of 49. So the spread was at 129 plus our cost. So 80 bucks per spread profit, 163% return, in a one-day period. So that's a really cool trade, for taking advantage of that kind of short-term swing. So that was a short duration, but we can also do these longer if we want. Now the next one is your butterfly. So this is an example of a wide wing butterfly spread. This was on Microsoft, one that we did here. So this is going to then, give us that wider profit zone. Again, structured for, defined risk, great for hedging. Great for target directional swing trades. So when I set up trades, I'm always looking at the direction, up or down. That's kind of the underlying basis of the trade. And then we can reduce and shape our risk by using these different spread components or structures. So this was the butterfly. Also really great for pinning trades. That's where when the market at expiration on an expiration series, you get it to go out right at the strike, at a certain strike at expiration. That's what we call directional pinning. I'll show you a really good example of one we did there. Really great for high volatility markets because we can really reduce our cost of capital or risk. And we can also always have a positive theta. So great for volatile markets. So great for high price stocks, reduces the cost of the trade. Trade duration, kind of 1 day out to 2 weeks is kind of the duration time frames we're looking at. Will always give you a positive theta, no time decay. We get returns of 2 to 1 up to 25 to 1 on these types of trades. They can be really incredible. So of all the different option spreads, this will give you the potential for the biggest return. All right, but it's not one we use, for every trade because there are some things that these are good for, and then market environments that we're going to use something else. A lot of times will either be a butterfly or condor, or will be going to be some kind of diagonal. Okay, so those are kind of our debit spreads. Those are kind of the ones that we go back and forth to. So here's a example of one that we did on Microsoft on a long trade. Again, these are trades that we did, a part of alert service trades just to show you. So this is a Microsoft long. It was trading at 280.40. We were looking for a breakout over 283 with an upside target then of 290 and then up to 295. So we wanted to keep our risk low. So we used this call butterfly. So went out and bought. This was the 6 April series, 285, 290, 295 butterfly. So $5 wide spread. Look at the cost, 75 bucks. So that would be our total risk, 75 cents or $75 for this butterfly trade. Then here it was on the 31st. It was, trading up. Now it was up, went from 280. Now it was trading at 284. So I just sent an alert if long multiple contracts, go ahead and take some profit, hold the balance. So at that time, it was up about 45. And then it was up here ripped up to 287. So went ahead and butterfly currently up over $60 per spread or 207. So, that's kind of always updating these trades. So that was a kind of an example there. So here was the trade set up. We had this multiple different profit target zones that we hit. So it was on the 29th, it was trading right here. My momentum was up. So this is kind of the basis of the trade. We're looking for a break to the upside. So then on the 31st, we took some profit. It was trading there. And then on the 6th, it was trading there, had the max profit on that on the 6th. So these are things that you put on and you kind of gradually leg out, take your profit on the way up. But here's one that we did just to show you how the potential profits are huge on these types of spreads and very low risk. So this was 6 April expiration. We were targeting that 290. So $5 wide, 285, 290, 290, 295. So there was your debit call butterfly $5 wide spread. So $500 less your risk of the trade, 73 bucks. Okay, so debit cost. So potentially you could make $427 if it went out there on expiration. That'd be a 585% return. So you're risking $1 to make 585. Really nice positive risk ratio. So that's potential there. And here's your 427 potential profit on your risk of 73. So that's just your profile. You can see how these returns can potentially look great. So this one is where it went out that day on the, this was on the 6th right here. So it went out, it was trading out 491.76 right there. So the spread we had on originally at 73 bucks, and now that spread had blown out to 324. So we had a profit of $251 per spread. That's right there. So we didn't get the max, but close enough, right? And so 343% return. So if it had gone out there, that would have been, let's see, back up. If we nailed it perfectly, that would have been a profit of $427 or 585% return. But this made 343 over an 8-day period. Now, the next one is pretty amazing. This is one I just loved to look at. This is one we did to show you how these things can really make these huge returns on very low capital risk. So this was what we call a penny trade, and this was one that we did on Tesla. So this was in February. So Tesla was trading at 189.35, and we were looking for a move based on the charts and based on what we call option open interest analysis. We were looking for potential move to $200. All right, so on the 16th, we'd set the trade up on the 8th. On the 16th, it was then trading at 200. So this went out up $231 per spread, 1,925% return over that 8-day period. So here was the trade. It's what we call a binary trade. So Tesla long binary monthly penny trade, trading at 189.35, set for potential monthly expiration at 200. So went out and bought the 16th February butterfly, the 197.5, 200, 202.5. So that was a $2.50 wide spread or $250. The cost of the trade was 12 cents or $12. Okay, so very low. So if everything went wrong, you'd lose 12 bucks. But if everything went right, you have potential to make, over 230. So then on the 16th in the morning, it was trading right here. It was trading at $200. So that butterfly now was up to $215 on the spread, over 1,700% return. And then here it went out right at the close. Just pretty amazing. Went out right there, pinned at 200, and it was up $230 per spread, over 1,900% return. So that's how you could take advantage of something that gives you these huge returns. So here's where it was trade was established on the 8th, right there, right here, and then we took it off right there, perfect pin at 200. So these were a lot of fun, and your risk in this trade was 12 bucks. So here's the trade spread here. So we're targeting the 16th expiration, targeting 200. So we did the 197.5 call, long, short the 200, short the 200, long the 202. So we had the butterfly. Max risk was $12, 12 cents right there. The potential profit spread width of 250, less that. So potential $238 if it went out at that point right there. So that's a 1,983% return at expiration if you get that. And this made very close to that. This is one of the few ones I've ever seen pinned this close. So it was really amazing. So here's where it went out. That was on the expiration day of the 16th, and it was trading right there at 200. Amazing. So it was up $238, 1,983% return. So it went from 12 bucks to 250. So that was about, well, that was perfect. So rarely do you get anything like that, but I just wanted to show you that these things are possible if you use the right, trade setup for the, situation you're looking at. Now here's an example of a long condor debit spread, okay? And this is one that we did on Meta. So this was a directional move to the upside using what we call a long call condor. So this one is great because similar to the butterfly, it's going to reduce our risk, but we're going to, instead of the butterfly having a really, tight window, this is going to broaden out the profit zone, okay? So it gives you a wider profit zone than the butterfly. Also structured for defined risk and hedging, great for hedging, which we can establish different hedges and stuff, a lot of different things we can do. So that's why you need to come to the directional course, because we're going to go through these in more detail. Great for swing trades, gives you that wide profit zone. Really great for high volatility markets because we reduce that risk, plus we're selling, we're having an option spread against it, bringing in more premium. Trade duration 1 to 3 weeks out. Always a positive time decay or theta, no time decay. Returns of 2 to 1 to up to 4 to 1. So really great structure. Here's the one that we did on Meta. This was back the 5th of June. We set this up. Meta was traded at 490. So went out, did a daily, this had a daily cycle low retracement reversal. So it come down to a moving average and was retracing off that. So we wanted to keep the volatility. It had also what we call a volatility squeeze, positive momentum. This is what I send out, which are, kind of give a description of why the trade is being set up so you have more clarity. And then I gave the target. We're looking for target 1 to 500, then 505. So this was buying a condor. So it went out to the 14 June series, bought the 490, 492.5. That was a call debit spread side, and then sold the 510, 512 and have call spread against it to set this up around $80, 80 cents, $80. So it was a debit spread, max risk around 80 bucks. And here's what that looked like. So here was the trade setup right there. Again, this is what we call a volatility squeeze, where you had this really tight compression of price. We did one on Friday on Google, and I'll show you that one next. But we were looking for a potential break out of this kind of range here. We had positive momentum, so we're looking for this breakout of that range. So the condor is one I like to use for this kind of structure, this kind of pattern. So then it did break out and, ended up with profit out here. It went out right, between our two spreads, which was, the ideal, kind of outcome. So that it was a trade at 503.94, right here on the 14th. So this is what the trade profile looks like. You're risking this setup at $65 debit cost. So you can see you're long the 490, short the 492. So that'd be your call debit spread side, and then sold the 510, 512.5, bear call credit spread against it. So we can leg these or do these all at once. All right, so we have that long call debit spread here. Then we have the credit spread against it to reduce our capital at risk, also reduce our data, and a nice wide profit zone. So total risk is 65. Potential, if it goes out in here, is 185. So you have potential for a 284% return. All right, so we had the 490, 492 called debit spread, and then the 510, 512.5 credit spread. So those combined together creates what we call this condor. And they're great for legging, so we can leg in, leg out if we needed to. Sometimes we just put it on as the condor itself. And so here's where it went out on the 14th. Went out right there, right, pretty much right between the two spreads. So at that point, it was trading at 503.94. So the spread blew out to 250, and the cost of the trade was 65. It was up 185 or 284% return. Now here's one that we just did. This was one that we did Friday. This was a long call condor on Google. So we'll see how this turns out. Let me pull it up and I'll go through the trade and what we were looking at on this one. So here's Google. So we're watching this. This is again what we call a volatility squeeze. 1 second here. And we had a squeeze on the multiple time frames. Here is on the 4-hour right there, and then we had a squeeze going on with the daily. So with this, we're looking for potential for this to break to the upside. So we'll see what happens next week. But we want to keep the risk low. So here's what it looks like, and then we're looking for the potential breakout. See, this is the prior high. So it's been just consolidating up here. And this has potential, if we get that momentum to kick through, to break higher next week. All right, so if you look here, I'll take off these, let me take off these Fibonacci studies here so you can see it better. All right, so here you can see it came up on Friday and broke above the prior week's high, that dashed line. So it did break through there. So that's kind of a little penetration. That's good technically. And we have our momentum indicators are up, cycle 1 and 2, had good volume. Look at the volume there. So this has potential. And then you can see if it breaks above that, it's got potential to run up to those next levels. So we did this though with a low risk trade. So we did this with a long call condor. And so this is what it looks like. And then this gives us all kinds of things we can also do. But basically we set this up without legging into it. And so you can see down here below, we're long the 180, short the 182, short the 187, long the 190. So we're long the call debit spread here, 180, 182.5, and then shorted the call credit spread out here, 187.5, 190 right there. Okay, so $2.50 wide spread on each side. Cost of the trade, 85 bucks. That's the debit paid. That's our max risk. It's got a positive theta right there, 78. And you can see the potential profit then if next Friday it goes out right here between the two spreads. This would be $165 on the risk of 85. That would be a 194% return. But you can also see if it goes out, anywhere in between, it's got a really big profit zone. So even if it went out right here at 189 next week, at expiration, the TIL's expiration, this would be up about, that's where it would be break even. All right, so anyway, we can look at our profile there, and we can just, if we wanted to, we can adjust this to a butterfly. We can cover the short credit spread, drop it down, make it a butterfly. A lot of different things we can do there. So, basically you just have to look at your verticals. So here's just kind of another example of what this is. So we're along that vertical debit spread here, okay? So the 180, 182.5, and then we sold against it the 187.5, 190, okay? Now if we wanted to, next week we'll see what's going on. We could close out the 187.5. We could have closed that out on Friday, take a little profit. And if we wanted to, could convert this to a butterfly, all we'd have to do is shift it down to that short strike of the 180, 182.5, and then we'd have a butterfly. So here's what that could look like. Sorry, that's a broken wing butterfly. Let me get the, here it is right here. So we could shift it down to a butterfly and reduce our risk down to, $47, $45. Okay, cut the risk in half if we needed to. So a lot of different things we can do with this structure if you just know how to use it and when to use it. All right, so that's another example there. And then here is a counter diagonal. So this is one that we did on Oracle. So these are really, we do a lot of these, again, structured for defined risk, selling time and volatility. Yeah, hold on, Barbara. Yeah, here's the special link here. Yeah, here, use that right there. Okay, if you need to take off, just click on that. Make sure to take advantage of that. So here's a long call counter diagonal that we did on Oracle, structure for defined risk, again, selling time and volatility. So it's going to be a positive theta trade used for directional target trades. So we're always looking at the potential upside target to base these on. Great for income. We're getting paid while we wait for that direction to kick in. Sometimes it comes a little bit later than we want, but we're getting paid. Has the potential for greater returns than if you just did the calendar, because it has a diagonal component. Trade duration of week to months. It could go out to years. These we've set up, using leaps years out. Positive theta, no time decay. So here's one that we did not too long ago on Oracle. And again, Oracle was, hold on. What did I do? Oh, here we are. One second here. I stopped my pointer. This is weird. 1 second. Bear with me. Did something to my pointer tool. Let me see if I can reopen it. Oh, here we are. Finally, it was pilot error, usually the case. So here's one that we did on Oracle. So on the 16th, it was trading 121.83, and this was coming down. We're looking for that turn, right? But we wanted a little, buy ourselves some time if it took longer to have that turn. And this one, we didn't have to stay in too long. It turned it pretty quick. So it was then on the 22nd, it was trading at 125.16. So you can see here it says, trading there. So trade set up to play a daily cycle low retracement. So it's coming off of retracing off a moving average. And then we did this, it had good momentum. So it looked like it was going to push to the upside. So we went out and we bought the 31 May and sold the 24 against it, the 122, 125 at around $1.50. And then on the 22nd now it was trading at 124.05. So we took the trade off, started to take a profit there. So here's what this looks like. So set up right there, directional trade set up to begin with right here. We had good momentum. Everything we look at said, a good trade setup was breaking that 50 simple moving average. So it's trading right there, 121.83. And we set it up to give us a little bit more time, but ended up, popping up there to this 618 retracement right in there. And so here's where the trade setup went out. So turned out pretty good. Now these are not going to be returns like you get with the butterfly or condor, but these are ones that we do strictly for a trade environment where we want to have a trade with more time and we have positive data. So again, think of a covered call, but instead of buying the shares, we're buying the longer dated options. So you can see here we're out. We went out to the 31 May, bought the 122 call, but instead of doing everything at 31 May, we sold against it the 24 May 125. So short duration short, longer duration long. All right, so that's the calendar diagonal. And so the spread when we set up was $1.47 or $147 per spread when we set that up, and then it went to spread blue to 250 or 250. So this was, right there, $103 per spread or 70% return, on the 22nd. So that's kind of a typical, really nice and clean calendar diagonal. Now here's one that we did. This one was a really cool one. And this one is the reason I want to show you this one is because we can adjust these trades a lot of times. What we'll do is I always tell members, everybody that think like 2 to 3 to 4 steps ahead, looking for ways that we can adjust trades to either reduce the theta or reduce the capital at risk, which is going to improve the potential return. So this is one that we did that worked out great, that we actually then adjusted this to a butterfly. So here's kind of walk you through how this worked. So this was originally set up with Exxon, a good long call calendar diagonal to start with on the 5th. It's trading at 105.80. Now the chart looked great. It looked like it was going to, really potentially have a move up. So we wanted to really work the trade to the upside, thinking this could be a longer term trade. But when we started out, we did this then as a calendar diagonal. It was trading at 105.80. We had everything was looking good, our charts, everything we looked for, positive momentum, good chart pattern. So we went out and we bought the 22 March to begin with. So further out time, 22 March series, and sold against it the 8 March, and we did that the 106, 108. Okay, so $2 wide, started the spread out just $2 wide or $200 wide spread. And then we're going to work the trade up. And then on the 13th, we adjusted it. I won't go through this, I'll just show you the charts. So we did our first adjustment on the 13th, and then we took some profit on the 14th. So the Exxon then it was adjusted. Now we're in an adjusted trade. We're long the 22 March 106 and short the 15 March 110. So we're widening out that spread. And then we took some profit and we're working it up more. So just kind of highlight that, but let's go through the actual spread. So here it was, the original trade setup, and it was a really nice tight squeeze that had been going on for a long time. So we felt that this thing had all the makings of a big breakout. So here above it is the 200-day moving average, that blue line, 150 days. So if it could break above these key moving averages, it had what I call open prairie. There was just a lot of potential upside. So, that's why we did this as a calendar diagonal, because it could have churned for a longer period of time, but we felt at some point, though, it's going to break out. And it broke out and broke to the upside nicely. So the trade then we set at 105.08. Okay, so we then adjusted on the 12th, did our first adjustment. This trade at 108.65. So we were then long the 22 March 106, short the 15 March 110. All right, we originally started the trade out of $2 wide spread that I showed you. Now we're widening the spread out, and now we're long the 106, 110. So $4 wide. We started with $2 wide, widened it out, and we're taking profit as we go. Okay, so let me just kind of walk you through the progression of this one. These are great trades. So, originally at 105.80, then we did the adjustment on the 12th. It's trading at 108.65. Took some profit on the 13th. It was trading at 109.95. Then we did another adjustment, working it up on the 14th. It was trading 110, and then we took more profit on the 15th, 111.92. So you can see it just working it up. And then we adjusted the balance into a butterfly for a free trade and a big, huge profit. All right, so here was the first trade adjustment right there on the 12th, 108.65. Adjusted to the 106, 110. So we had the expiration series now out to the 15th of March. All right. And here's the second adjustment. So here's the profit on that first move up. So profit on the 13th right here. So went from 179. So this was the 106, 110, $4 wide. Now that spread had blown to 364. So we're up $185, 103% return. So these are partial, you're just taking partial profit, trying to work the balance up, or, you know, if you had one contract, you could have taken it all there. And then the next target, we worked it up. We were now up to the 14th. We adjusted it to the 22 March 107. We worked the whole spread up, locking in profit. So now we're long the 22 March, same long series, right? The 22 March series. And then we're short the 15 March 112. So we went from the 106 to 107, locking in profit, widened the spread now out to 112. And then we took some profit on the 15th. You can see it was trading out 111.92. So now we had the spread adjusted to 151, $5 wide, and that spread had blown now to 485. So we're up $334 per spread. That's up 324% return. So just kind of working the trade up, and then saw the opportunity to trade this into or turn this into adjusted free trade. So did that with any trade balance that you had. And so this was on the 15th. So the key was we were still into, you know, originally we're into the 22 March was the long part of the trade, right? So, and then we were long, we adjusted up to the 107. So what we did then, we adjusted this to a butterfly on the balance. So long the 107, and then sold in that same series of 22 March, the 113 call. Okay, so we had the 107, 113, and then we sold the 119 call against it. So we did the 113, 119 call credit spread. So we had this butterfly right there. So we're long at 107, short the 113, short the 113 again on the credit spread, and then long the 119. So we had this butterfly set up, and we did this now where we had the max risk of $20. Reduced the risk down to $20 per spread, $6 wide or $600. So potential return, if it goes out here, 580, that'd be a 2,900% return. So these are, you know, potentially real returns that you can get. And so this one was pretty close to hitting that that return. So you can see where it did actually go out, you know, on, here's where it actually did go out here on the 21st was right here. So took this off the day before, it's trading right there. So it went from $20 that we adjusted the trade to $515. Okay. So that's a profit. That was up to $495 per spread. That's a 2,475% return. Okay, so those are, you know, the things that, and it's just a question of understanding the spread, then knowing when to do it and how to do it. So, let's, think about, what I just kind of covered today. There's so many, things that you can do, and these are some of my favorite trading vehicles for any and all markets and market conditions, but I just, was only able to scratch the surface today. So want to make sure, if you'd like, make sure to join me next week. And or this next weekend on Saturday, next Saturday, and we're going to go through here now kind of the steps to take and start mastering these kind of trading strategies for the benefits of options provide you. So next weekend, starting on Saturday, I'm going to be, holding this live course, which will be recorded, the Ultimate Option Guide, when and how to use which option strategy for the best results. So this will start, and here's just that quick link again for you, and then we'll go through the details. So it'll start next Saturday, the 29th, at 11 a.m. Eastern to 2, or however long we need, and then we'll finish up a lot of stuff we're going to be covering on Monday, the 1st of July. Wow, summer's already to the midpoint, 4 p.m. Eastern to 6. And this will, live plus recorded. Then we'll do a follow-up Q&A the next day on Tuesday. So this will be a 5+ hour, option workshop. I'm giving, the 9 enrollment bonuses, so, value of this over 3,800. So just $197, right? So really great, low price. And if you've been wanting to learn all the different strategies or just one, here's a really great way to take advantage of, today it'll be 167 if you use that OP15, your code there. So you're getting, the value of the course, just the course alone is $1,750, on that. So, you're going to get this for 167. And then I'm giving you these bonuses, to, help you improve your trading. So this is another really great option. This is more focused on the Greeks. You're going to get my price target mapping. This is how we set our profit targets or defense targets. So this is a Fibonacci price target mapping course you'll get. Get started trading options today. Another really nice medium-term beginner course there for you to start with. So this is a full option package course. And then you're going to get a 30-day trial membership, $97 if you want to stay on after that. Or we have other selected packages. You'll get my cycle reversal indicator, my extreme range band indicator. We'll do a follow-up Q&A after the event, and then you'll get my option trading tutorial, another option course on the Greeks, and the 15 option strategy guide. So a really huge package of bonuses. So full value of $3,800, so $197. So 94% return off or percent off. So that's a look there. Now, if you want the alert service added to it, then it's $597. This breaks down to basically you're looking at $100 a month. So $597, and then your course package 1 is $197. So that your alert services get basically being priced at $100 per month. So really great low cost there. If you were to break that down, on a 30-day basis, $13 a day or something. So if you're looking for more help and guidance, and don't have time to find your own trades or want more selective trades than what you're finding, then take advantage of package 2. Okay, so just go to that link, click on that, make sure you use OP15. So with this, you're going to get all 5 of my alert services for the next 4 months. You can stop and start whenever you want, plus the 4 months to the trading club. Everything in course package 1, but my 5 different alerts plus the trading club for 4 months. So you get my butterfly long condor setups that I sent out. That was one that we sent out Friday. That was Google. You'll get my counter diagonal trade setups that I send out. We did one Friday also on XLE and calendar diagonal. Breakout reversal or credit spreads that I send out. Butterfly pinning trades that I send out. And selective earnings trades. So it could be, depending on the market environment, what we're doing, could be any of those different trades, during the week. So that is what, referred to my elite open and close trade alert service system or package. Live course indicators, all bonuses, $597. Use that link today. You'll get this for $507. So, it basically, try to, shoot for, 8 to 12 stocks or ETFs per month. This week we did, what do we have? We did XLE, we did Google, we had something else on it. We do a lot of different trades, but here are the 5 different types of trades that you may be sent out for, or I may send out. So when I do send it out, a lot of members just do their own thing. They just they just want the trade, right? And then they'll just go to long calls or puts or the shares, whatever. But when I send out the trade, I'll always give you an option, a selected option strategy that I think is appropriate, for the market setup that we're looking at. So I'll give you the trading guide alert. And then if we need adjustments, I'm constantly monitoring these trades each and every day, all day long. Then I send out a video review after the close. Trades are listed and archived, so then you'll have access to my weekly Q&A. Yeah, then we also had GLD on, I forgot, and then we took that off the next day. It started to go back down. We closed that out at a break even. Yeah, GLD, forgot, we get so many different trades a lot of times. Do a video newsletter after the market close every day, so you can kind of get my viewpoint of what's going on. We have the virtual trading room open each day from 8:30 to 9:30 Central. So come in there if you have a trade setup that you need help on or see what we're doing. And then you're going to get a member's discount. You'll get your members code where you get 60% discount on everything on the website. So again, go here and use that special link I gave you. Here it is one more time. Click on that, and then you're going to get everything here at a discount. Just use that OP15 small cap. and you'll get the discount off the course and everything there. All right. So here's kind of going through the alert service summary. Again, started the first alert service back May 2018. Wow, it's been a while, huh? And through yesterday, we've had 743 closed out, 536 winners, 49 break even, high 158 losers. High winning percentage 79%. So really look for really selective trades and want high winning percentage. And here is kind of an outline of what we're going to cover starting next Saturday. We're going to go through, we'll start out with the kind of foundation, option Greeks and how they are used for your trading edge and these different strategies, how that option pricing works for selecting the best strategy. Really important to understand standard deviation for setting up your probability trade analysis, price target, forecasting, things like that. So we'll go through, make sure you understand how to do that. The importance of how to use your option delta for these trade probabilities, how to do that for all your trades to assess, risk. And then we'll get into how, why, and when to take advantage of volatility and volatility skew, the two different skews that we'll talk about as a positive and negative skew, how those can affect and benefit your trade, how that works. And then we'll get into the actual strategy guide. So we're going to go through the process I use for then selecting what strategy to use and then when to use it based on your market cycle, the environment we're trading, market environment, and the chart pattern. So a really specific selection process for this, which will then kind of guide us to, what then is the best, option strategy to use? What are they and how to use? What's the best, buying strategy? The same, what are they, how to use? And then the best option butterfly, that we use a lot of times, which really provides that huge trading advantage for high volatility markets where we're, combining selling time and volatility and hedging. So these, can provide us returns of 100% to over 1,000% or greater. The major trade advantages of our long option condor, we do a lot of these, and this course will really define how we use them, when to use them, and why, because there's such a low defined risk, positive theta trade. So then we'll go through the kind of step one, the go-to hedging strategies used, which are typically going to be butterfly condor, and then why, how, why, and when to use that condor spread. All right, so then we'll get into the counter diagonal, which is the other really kind of go-to strategy, which you really need to have for your portfolio trading or investing. Which is a medium to could be a long-term directional timing income strategy to use. So how the counter diagonal works to create a market neutral but directional trade, which is defined risk, for both income, getting paid while you wait, and the potential for big profits from market direction, kind of like that Exxon trade. You turn these things from, just kind of keep working them up, for directional moves. Then how to structure it for your profit from the difference in time decay and implied volatility. So we'll go through how to incorporate, taking advantage of volatility skew and, working that short dated versus long dated series, selling time and volatility, how, why, and when to use. And then we're going to go through, just the go-to strategies, make sure you understand with a lot of different examples. And so we're going to go through buying and selling options, when we're going to do that, using the vertical debit spreads, calls and puts, butterfly long condors, and the counter diagonal. So these are the kind of go-to strategies we'll cover in this course with really good examples of, how to use, when to use, and the variations of market conditions, okay? How, why, and when, and then also when to use for hedging, and which then also take you through what I call the progression of hedging using these options to do that. Risk management, how to adjust, reduce your position risk. Okay, so we'll go through adjustments. So there's a lot in this course that'll be covered. How to adjust your trade to that free trade, like that Exxon trade, So that's what we're looking at, the steps that we're looking for in that. Make sure that you're going to understand assignment, expiration risk, auto exercise. A lot of people will get pretty freaked out about, short strikes getting assigned. So we'll, in this course, we'll lay out what you need to know and just kind of make sure that You're not worried about that because it's a real simple, way that we can look at options to know we're not going to get assigned. So you'll learn that in the course. So no need to fret about it. And then you've got a good trading library, of past trades you can go by and look at, or go look at, which is really helpful to learning. Looking at past trades, the good ones and the bad ones, to see what you did right or wrong. Here's from Dennis. He said, just finished the Option Masters course, loved it. Hedging on demand is a game changer and allows one to enter trades with confidence. Already 2 of my probability trades, which were heading into my short strikes, were converted to the butterflies, which I exited at a higher profit than the original trade forecasted. Slept much better, and the funds were then reinvested. Compounded interest is a little magic seldom mentioned with options. So nice feedback there. And here is just going through the enrollment bonuses. Here, John, here's the link again. If you just click on that. Let me make sure everything's working. Click on that. And then, then you just scroll down, make sure you use OP15, and then select the course package you want, right there. Now the indicators, if you do want the indicators, they're available for Thinkorswim, TradeStation, TradingView. Okay, and then course package 2, if you want the alert service added to that course package 1, it's $597, but using the 15% off, we'll drop this down to $507, and course package 1 will be $167. So there, use that. All right. Now we're going to go through the Option Masters course. This is a bonus that you're getting. This is a course that I did, and this one is like a 6-hour course, but what it really breaks down, it's more focused on the option Greeks, okay? Greater focus on the Greeks, everything you really need to know about gamma, theta, delta, okay? So this is a really good one that I like to add to this option guide course, okay? Really, really good one to complement, what we're going to be teaching. So, but this is in greater detail, so I can't cover that in the course, just not enough time. So I give you that, and then you're going to get my bonus to my price target mapping course using Fibonacci. So what this does is not only uses Fibonacci, but it uses moving averages, trend lines. Okay, that's incorporated with it. Price action, support resistant levels, and then standard deviation and option activity. So it's a really great course that I put together to show you how to target, really good target prices up or down for your trades. So, 3-hour plus course manual, trading handouts and videos. So you'll get that as a bonus. So all the trades that we do, we always outline the Fibonacci, our target, the price target before we put the trade on. And then you're going to get, I thought this is a really good complementary course as well, Start Trading Options Today. So even if you're just starting out, this is a great course package at $167 because you're going to get everything you need to know about options. So this is kind of more of a beginner's course, but what it does, it will really solidify, options. So what are the benefits of options versus stocks? Insider tips you need to know before trading options. Must know option basics, puts and calls, mastering that better. How option expiration works, and then there are 3 strategies that are covered in the course: covered call, the covered call with the protection collar, the collar hedge strategy, and then the vertical debit spread. So really good complementary course to go along with this Option Masters course. So I wanted to throw that in, and then you're going to get a 30-day trial membership. You can start this whenever you want, or if you do the alert service package, you'll get this for 4 months. So we have the trading room opens every day during the week, 9:30 to 10:30 Eastern. Then I do a daily video newsletter after the close, what the markets are doing, what we're looking at for the next day or so. Member videos are archived. Then we do a live weekly Q&A that's recorded. You'll get additional trader educational material in the Trader's Vault and 60% discounts on all courses and software. So if you go to my website, you'll see. Here, let me show you. You'll get anything on the website using your members discount code. Any other courses that I've done, which are mostly option related, you can buy any of these courses. You just go down. Here's one that just recently, it's pretty cool, Synthetic Option Covered Call Workshop. If you want to buy that, you go in here. It's $297. Click buy. and you'll put your members code in, and you'll get a 60% discount off that price. So you can use that for other types of courses. And then I've got just a lot of trading indicator software that I've designed and built. So you can get any of this for 60% off. Now with the course, you're going to get as a bonus, these are two really important indicators, my cycle reversal indicator and my extreme range band. So these are, on the website, these are $197. So you're going to get that, because these are important to use. So all that. And then I like this from Jay, one of my members said, reading books is fine, but seeing the actual option trade setup makes a huge difference. So that's what you get in the virtual trading room. All right, so come in, and if you have a problem with the trade, come on in and ask, and we can help you out there. Now you're going to get my cycle reversal indicator. So this is, will show when cycle reversals happen based on this indicator, and it'll also illustrate overbought, oversold. So, this is available for Thinkorswim, TradeStation, TradingView. So it's got an upper and lower study. So when the cycle reversal happens, it's going to give you an arrow, coded arrow to show the reversal. And the lower study is where the actual signal comes from. It also shows overbought, oversold. So this is one that we use a lot. So super important for your trading. Here's just what it looks like on Thinkorswim. So you can see we had a cycle reversal here, cycle reversal on the daily. So then, up she goes. And then that's just a screenshot of that. And here we even have it for TradingView. We have it for TradeStation as well. You can see right there. And then you're going to get my extreme range band indicator, which right now is going to be really an important one to use. So this one is available for Thinkorswim, TradeStation, eSignal, Ninja, Trader. So this is the one when we get in a market that's kind of currently like we're in now, that's getting extremely stretched. This will help us kind of to navigate extremes, right? So this is based on average true range. So you can see here, this is the extreme range band indicator that you're going to get. Here's just like, for example, a weekly to show you extreme. This is SMH, the semiconductor ETF. So here it is up at that third ATR, just really super stretched. And then when we get this kind of stretch, which leads to buying exhaustion in this case, when we get the indicator to roll over, it gives you a really high probability time to exit the market. So you can see the last time we had this stretch was back here, and then we had the reversal right there. And then you see it had that mean reversion back to the 8 and actually went back to the 21. So really helpful tool. So you'll get this as a bonus to help you, spot these cycle trends and things like that. All right, so you'll get that. And then bonus 7, we'll do a live follow-up Q&A. We'll do this probably on Tuesday. And so then you come in and ask whatever questions you have on anything, plus the course that will go, we'll have more time on that. And then, again, you're going to get the 30-day trial membership, so even more support there. Then I'm going to give another option course. This is really more focused on the Greeks as well, Gamma, Delta, Theta, option pricing, probabilities. So 60-page option guide with videos on the Greeks, so we get that. And then one last thing, my top 15 option strategies. So this is a really good guide to the construction and when to use other variation spreads like the back ratio spread or an unbalanced ratio butterfly or a strangle, things like that. So just to give you this is just a bonanza of option, content. And then here's the lead open and close trade alert service, just to kind of go through that one last time. Here's from one of my members, Waleed, who actually lives in Kuwait. Says, Larry, I have to mention one thing. I'm subscribed to a lot of services who send out trade alerts. Some are good, others are not that great. But one thing I'd like to people on this webinar to know is when I get a trade alert from Larry, I do it blindly as time has shown that this man is that accurate in his recommendations. Thanks, Waleed. And here's from Dan. He said, you are very diligent, totally thorough with your analysis. That is the foundation of the success of your alerts. I paid for my subscription with the first 4 trades I took with you as I was learning how to trade options. So that was pretty cool. you know, from Dan. A lot of members have learned a lot just from the alerts that I send out. And yeah, here's the link again, John. So anybody having any difficulty with the link, let me know. And so again, just one last review here. So lead open to close. If you want that package, you get, you know, all the 5 different alerts that I send out. Could be a butterfly or condor, could be a calendar or a calendar diagonal, could be a monthly butterfly pinning or calendar pinning trade, breakout reversals. These are typically at credit spreads, selective earnings trades. So when I send it out, you know, I'll send out the price that you want to try to enter into it around the trade, but, you know, always give an option, you know, selective options trade for it. And then you get 4 months of the trading room, which gives you the video newsletter every day after the close, virtual trading room, 60% discounts off of everything. So when I send out the option trade, I'll give you the entry level, potential profit targets based on, you know, your price target mapping, which includes option activity, Fibonacci levels, etc. What option series to use, then your stop loss and guidelines. So then I'm going to guide you through the trade as long as the trade is on. So constantly updating any monitor, anything that needs to be known during the day. If something happens, I'll send out alert, you know, alerting you to that. And then if we need to make an adjustment, I'll send out alert on that. And so these are, you know, constantly updated during the day if something needs to be done. So use a service called Telegram. You can see right here, this was from Friday. So here we did a couple of trades on Friday. We did a counter diagonal on XLE, and then we did the Google, and then at the end of the day, XLE was pulling off, so made an adjustment on XLE. So right there, so just a lot of stuff. And then I'm constantly monitoring these trades and updating you if you need to know anything. What option series to use, and then these trades are archived and listed, so you can go back and look at them. Then I do, after the close each day, you know, the trade setup, I'll do a video review of it to kind of go in more explanation of why I, you know, was looking at the trade setting up. And then, you know, overview of the market that day as well is done. Then your access to the weekly Q&As, which are live and recorded. So you'll have this for the next 4 months, and you can stop and start your membership whenever you want in case you need to go on vacation or work or whatever. And that's pretty much everything you'll get there, plus that Trader's Educational Vault. And here's the summary. We're, you know, running around 79% on the trades. So here are just a few others. Here's just kind of going one last time through the butterflies and long condors. So this service started back in May of 2019, and through yesterday we've had 171 trades closed out, 120 winners, 12 break even, 39 losers, running 77% winning rate. These can give you returns of 2 to 1 up to, you know, that 25 to 1 as you saw in that Tesla and the Exxon trade. And these are unaudited, but that's a summary of you know, what we've done. And then here's one that we did just not too, this was recent. This was a long call condor on NET. And so this is one that we did. This turned out pretty good. This was on the 14th. It was trading at 75.40. So here was new net long, weekly cycle low retracement. I try to give you a description of why I'm doing the trade. And so it was reversing off the 100-day moving average, and it had what we call a 513 upside cross, positive momentum. So we did this as a condor to reduce our risk. So I said get into the 76, 78, 80, 82 at around 52 bucks. Fast moving market. And then on the 18th, now it was trading at 79.70. And so, you know, said taking profit on the balance, etc. You know, so this would then explained if you know, got out a little bit early on this trade because the next day, this was going into the holiday, you know, that we had last week, or this week, I guess it was. So I was worried that it might gap up on Thursday. So we went ahead and took the profit on the trade on Tuesday, okay, or Wednesday, yeah, Tuesday, I guess. And so here was the trade setup. This was everything we look for. These are really selective trades. So here's like the 4-hour time frame, momentum up, cycle reversal, momentum up, took the trade right here. And then we were targeting, this was our kind of trade zone that we're looking at between 78 and 80 right here. So on the 18th, it was going out right there at 79.70. So we went ahead and closed out the trade. Super low risk, positive theta, everything that you're going to learn in the course, but this was one that would have been highlighted to do. So it was long the 76.78 call debit spread, $2 wide. Shorted against it the 80.82 credit spread, $2 wide. Total risk, $51. Potential profit, $2 wide spread less that risk, 149, 292% potential return. And we closed it out on Tuesday, right there. So we didn't get the max, but we still had a great return. So the spread went from 51 to 124. So up $73, 143% return. Low risk trade, positive data. And you know, that was one we did just recently on net. Here's another one. Here's one we did on Skyworks. This thing just blew straight to the upside, but you know, like I said, this was the trade selection, and some members just do their own thing. So here was Skyworks. It's trading at 95.15. So this had a volatility squeeze and a weekly cycle low reversal, plus a 513 upside cross. I give very descriptive alerts when I send it out, so you understand the thinking while I'm doing the trade, or you know, sending out the trade. So this was set up for big breakout, 95, 97, 98, 100 call condor at $50, and this thing just blew straight to the upside. But this shows you the trade selection process. Let me erase this. And so Skyworks turned out it was a beautiful directional trade that just ripped straight up. So we got in right there. This thing was just amazing. We got in right here, right there on that, see that break? And then it just went straight up, actually went straight to fill that gap. So some members just do their own thing and just, you know, just buy the calls. This thing was just amazing. Went up 10% in 3 days. But that was one that we set up, an alert trade that was sent out. And here's another one. Here was that Meta trade. I think I showed you that one earlier, so I won't go through that one. Here was Meta. Did that one earlier. Here's another one that we did. This was a recent one we did on Coin, which is a kind of a crypto exchange trade. So this was one, just a variation, just looking at the different alert scanners that I do, scans and stuff, looking for these types of trades. This is one we did on Coin. And so new long Coin long, it was trading at 235.80. Had, again, daily volatility squeeze, positive momentum, targets 1, 2, show all that stuff. So here was going out. And again, here was buying a call condor. So bought the 235, 37.5, 260, 62.5, super low risk, $80, around $80, positive theta. 29th, 30th, took the trade off. Now it's trading up to 245. So we entered on the 24th, did an adjustment on the 29th, and on the 29th now we were adjusted this trade, narrowed the spread. So we started out 235, 37.5, and then wider. So we were like further out like that, and then it came back down. So we narrowed that spread, the condor, to make it narrower, to make it cheaper. Okay, so that was the adjustment there. Just a quick summary of that while we did that. And so here was a trade, the breakout right there, and got out right there. So here was the potential, just a profile of the trade. So total risk of $63. Here's the spread, 235 call, short the 237.5. Then we adjusted it down to short the 255, 57.5. So it looked like that. So spread $2.5 wide, $63 of risk, potential $187, 296% return if we nailed it right in the middle, but this gives you a big profit zone. So went ahead, took this off, you know, a day earlier. So we're worried that it might fall back off. So closed it out right there. You see, it still had a big potential for a lot more profit, but it was trading at 243.77. So it went from 63 to 168. So we had still a really good return, $105, 166% return on that. So that was Coin. And so just a few more, just kind of want to make sure you get a variation of the trades that I'll send out if you're interested in this. And here's the counter diagonal alert service. Started this back in June of 2019. And we do a lot of these because these kind of trades will give you a little bit more time to have the trade work out. So you can see we had 284 trades closed out, 207 winners, 15 break even, 62 losers, run around 78% winning rate, again, unaudited. And here's just a few more to show you what you're looking at. Here's one that we did on Nike back on the 30th of May. And you can see new Nike long trade at 92.90, weekly cycle low reversal, daily and 4-hour volatility squeeze. You'll see the same thing, the same patterns over and over and over in the trades that I sent out. Okay, so reversals, volatility squeeze, plus what I call that 513 cross. So look good for potential move up. So we did this 14 June long, 93, short the 7 June 96 at about around $1.35. Then on the 31st, now it was trading to 94.37, and so we went ahead and took profit on the trade. Just you know, these are kind of singles and doubles, and sometimes you get it where you adjust it like the Exxon into a home run. But here was the Nike trade. You can see right here, nice breakout, and then we went ahead and took profit. And so here was the trade, just in and out pretty fast on this one. So got in on the 30th. And out actually the next day at 95 right there. So it went from 135 on the spread to now to 215. So $80 per spread, 59% return on that. And then the Oracle trade, I showed you that one earlier. And then the Exxon one, I showed you that one earlier as well. So these are just kind of a overview of, you know, what you'll get if you do want the alert package. So again, any questions, let me know. And yeah, here you are. One more time is the link to make sure everybody's got that. Everybody have the link okay? Any questions on that? Let me know. And if there are any questions, please fire away. I'd be happy to answer anything you're wanting help on or just want a little bit more clarity on. So here's one last look at everything you're going to get. So one last review here. You're going to get, use the promo OP15. Today it's 167. Get all these bonuses with this 167 price. So instead of 197, 167, and then the course will start at next Saturday, live and recorded. So if you can't make it all or can't make any of it, you know, still make sure you get the recording. And these are broken down in modules of 30 minutes or less. You'll get the full PowerPoint handouts, everything. So I give you a lot of good detailed content that you can use. And then you get the alert service, you know, 4 months to all the 5 different selected services, plus the indicators, all bonuses. And that's pretty much it. Any questions on any of this? Oh, okay. Yeah, you want to? Yeah, let's take a look. One more. The Google. Sure. 1 second. Let me pull that up. So I'm always thinking forward. You know, like with Google. So what I always have an action or a game plan if things don't work out according to the initial trade. So with this Google, what I'll probably do is if we need to, we can adjust this to a butterfly. So that'll be probably the first step. So you'll learn you'll learn more about this and the thought process in the course. So, but the Google trade, gives us that flexibility the way it's set up because it's basically a combination of 2 vertical spreads, right? And that's the beauty of using spreads. Once you understand the verticals, then we can mix and match and create these different structures for adjusting trades, things like that. So we're long that call debit spread and then short the credit spread. We can close out that credit spread, maybe for profit of $12. That reduces our risk down by the $12 we bring in. And we can sell, we can make it into a butterfly, we can shorten the condor, we can squeeze that in. Just a lot of things we can do. And then we can use our analytics. You'll see in the course, we can use our analytics to do what I call what if. So let's say let's say on the 26th next week, next Wednesday, is that the Wednesday? Let's see. Yeah, let's see. What if on Wednesday, let's see if it goes up to, let's say it goes up to, it breaks up here and it's trading at 182. We can see here in the analytics, and I'll show you in the course exactly how to do this modeling. Let's say it goes to 182 next week on Wednesday. You can see on Wednesday morning, if you came in and it's trading at 182 right there, this spread will be up 50 bucks, right? Or 51 bucks, maybe up a little higher, but this is not exact. And that would be on the risk of, 85. So you're still a really good return. So we can, we'll do that. That's a big part, the course, the modeling, how to use your indicators or how to use the platform, and things like that. So that's pretty much it. Yeah, Salvatore, you're welcome. Thank you so much. If you don't mind, I'll share that with everybody here. So here's one of my really good members here. And here's just a nice little testimonial, I guess you could call it. Thank you so much, Salvatore. All right. All right, well, that's it. And